Welcome to StockTok's deep dive into Motorola Solutions. Motorola Solutions is a global provider of mission-critical communications technology and analytics platforms, serving public safety agencies and enterprise customers worldwide. At the time of recording, the stock is trading at 441, sitting within a 52-week range of 359 to 492. The RSI, the Relative Strength Index, a momentum oscillator that runs from 0 to 100, sits at 47, which is neutral territory, suggesting neither overbought nor oversold conditions. The 50-day moving average sits at 451, just above the current price, while the 200-day moving average sits at 427, well below it. That spread tells us the longer-term trend remains constructive, even as near-term momentum has cooled. Let us work through the fundamentals, scene by scene, starting with a quick business overview. Motorola Solutions operates two primary segments: products and systems integration, which includes land mobile radios and video security hardware, and software and services, which delivers command center software, managed services, and AI-driven analytics. The competitive moat here is deep. Public safety agencies face enormous switching costs once their infrastructure is built on Motorola Solutions' ecosystem. The StockTok score comes in at 62 out of 100, a hold signal. Valuation scores 0 out of 20, health 14, profitability 17, growth 11, and smart money a perfect 20 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? At the time of recording, Motorola Solutions carries a trailing price-to-earnings ratio of 34.6 times. That is the price you pay for each dollar of last 12 months' earnings. The forward price-to-earnings ratio, which is based on next year's expected earnings, compresses to 26.3 times, implying meaningful earnings growth is already baked into expectations. The PEG ratio, which adjusts the price-to-earnings multiple for growth, with 1.0 considered fair value, sits at 2.17, suggesting the market is paying a premium above what the growth rate alone would justify. The EV to EBITDA multiple, a valuation measure that factors in debt and strips out non-cash charges, stands at 22.8 times. For context, peers in the mission-critical communications and industrial technology space have historically traded in the high teens to low 20s on this metric. So Motorola Solutions sits toward the upper end of that range. The Guru Focus Value, an intrinsic value estimate derived from historical multiples and growth, is 434, while the stock trades at 441 at the time of recording, implying a negative margin of safety of 1.69%. In other words, a slight premium to estimated intrinsic value. Wall Street analysts at the time of recording have a consensus mean price target of 505, based on 11 analyst estimates, with a high target of 540. The next earnings report is due April 30th of 2026, with the street expecting earnings per share of approximately 3.24. That upcoming print represents a near-term catalyst worth monitoring closely. Market sentiment around Motorola Solutions, as of the creation of this video, leans neutral, with insufficient recent news flow to move the needle in either direction. In our view, the valuation is full, not egregious, but the 0 out of 20 score reflects that there is limited margin of safety at current prices. Moving to financial strength, how solid is the foundation? The Piotrowski F-score is a 9-point checklist of profitability, leverage, and operating efficiency signals. Scores of 7 and above indicate strong health, while 3 and below signal distress. Motorola Solutions scores 6 out of 9, which is solidly in the healthy zone. The Altman Z-score, a bankruptcy risk model where scores above 3.0 indicate low financial distress risk, comes in at 3.94, firmly in the safe range. Now, the balance sheet carries some complexity. The debt-to-equity ratio stands at 4.05, meaning the company carries roughly $4 of debt for every dollar of shareholder equity. That is elevated by most standards and worth acknowledging. However, the interest coverage ratio, which measures how many times operating income can service interest expense, is a comfortable 8.2 times, suggesting the debt load is manageable relative to earnings power. The cash-to-debt ratio is 0.12, meaning cash covers only 12 cents of every dollar of debt, which is thin. The current ratio, current assets divided by current liabilities, a short-term liquidity measure, is 1.04, just barely above 1. The picture is operationally sound, but the balance sheet carries meaningful leverage that deserves monitoring. Next up, profitability. Is this business actually making money efficiently? We lead with return on invested capital. The return Motorola Solutions generates on every dollar of capital deployed across the business, which stands at 16.85%. That comfortably clears the typical cost of capital hurdle for large-cap industrials and technology companies, which tends to run in the 8 to 12% range, meaning management is genuinely creating value. Now let us walk the margin stack. Gross margin, the percentage of revenue left after direct costs of goods and services, is 51.66%. That is a software-like gross margin for what is partially a hardware business, and in our view it reflects the pricing power embedded in Motorola Solutions' proprietary platform. Operating margin, which captures what remains after corporate overhead and research and development spend, is 25.32% again, exceptional for this sector. Net margin, the bottom line after interest and taxes, is 18.44%. And free cash flow margin, the percentage of revenue that converts to actual cash after capital expenditures, is 22.02%. A business converting 22 cents of every revenue dollar into free cash flow has genuine financial flexibility. The 17 out of 20 profitability score is well earned. Onto growth. Is this business expanding, and at what rate? Over the trailing 3 years, Motorola Solutions has grown revenue at 8.6% annually. Extending to the trailing 5 years, that annualized rate rises to 10.2%, which tells us the business was growing slightly faster in earlier periods and has moderated somewhat more recently. A modest deceleration worth flagging but not alarming. For a mission-critical infrastructure company serving government and large enterprise customers on multi-year procurement cycles, mid to high single-digit to low double-digit revenue growth is actually quite respectable. The more striking figure is book value growth over the trailing 3 years, 175.8%. Book value is the net accounting value of shareholder equity, and growth of that magnitude typically reflects either substantial retained earnings accumulating on the balance sheet or a reduction in shares outstanding through buybacks. Given the elevated debt-to-equity ratio we noted earlier, this likely reflects aggressive capital returns to shareholders rather than purely organic balance sheet expansion. The dividend yield at the time of recording is 1.04%, modest, and clearly not the primary investment thesis here. The growth score of 11 out of 20 reflects adequate but not exceptional expansion, with some deceleration in the revenue trajectory, and the dividend offering limited income appeal at current valuation levels. Now let us talk smart money, what institutional capital is actually doing with this name. 12 top-tier guru investors currently hold positions in Motorola Solutions, according to the data available at the time of recording. That level of concentrated ownership among high-conviction managers is a meaningful signal in itself. Among the most notable holders, David Rolfe of Wedgwood Partners has allocated 5.13% of his portfolio to the stock and has recently added 24.61% to his position, a decisive increase that suggests high conviction from one of the more disciplined long-only managers in the field. Mares and Power Growth Fund holds 2.30% of their portfolio in the name and has also been adding, increasing by 14.73%. Leon Cooperman holds a 1.72% weighting with no change in position, suggesting comfort at current levels. Insider ownership stands at 16.14%, a high figure that means management has substantial personal wealth tied to the performance of the company, which is typically a positive alignment signal. However, the insider transaction picture is nuanced. Over the trailing 3 months, there have been 0 insider buys and 10 insider sells. Insider selling alone is not a red flag. Executives sell for many reasons, including tax planning and diversification. But the absence of any buying warrants acknowledgement. On the broader institutional side, 7.6% of 13F filers, institutions required to disclose holdings above certain thresholds, are net buyers, which remains below the 50% threshold that would signal broad-based institutional accumulation. The smart money score of 20 out of 20 reflects the quality of the names holding the stock, even as the buying breadth remains selective. And finally, the verdict. Let us bring it all together. On valuation, the setup looks stretched in our view, a 0 out of 20 score, a slight premium to guru-focus intrinsic value, and multiples at the upper end of what the sector typically commands. On financial strength, the business earns a solid 6 out of 9 on the Piotrowski checklist and clears the Altman Z-score safety threshold comfortably, though the leverage ratio of 4 times equity is a real consideration for risk-conscious investors. On profitability, Motorola Solutions is genuinely exceptional, gross margins above 51%, free cash flow margins above 22%, and return on invested capital well above the cost of capital. That is the kind of capital efficiency that sustains long-term compounding. On growth, the revenue trajectory is steady but moderating, running at mid to high single digits annually, respectable for the sector, but not a hyper-growth story. On smart money, the quality of institutional conviction here is difficult to argue with 12 high-caliber managers with meaningful allocations, and management holding over 16% of the company. The overall thesis, in our view, is a high-quality franchise trading at a full price. The setup warrants patience rather than urgency. We would want to see either a valuation pullback toward the guru-focus intrinsic value or an acceleration in growth metrics before the risk-reward sharpens materially. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That is the deep dive on Motorola Solutions. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.